Hi, everyone. Great to see such a good audience at this time on a Friday. We're very excited. Unlike most panels you've probably seen today, we're not everyone focused on one specific sector. And I think that's what makes it really interesting. So we're going to talk to you about tokenization from a regulatory standpoint, from an infrastructure standpoint, from a platform provider standpoint, and of course, from an investor standpoint. So this group here can make the perfect tokenization startup coming soon. Let's start perhaps with Laura, Imo, and Dan. Could you talk about your organizations, what you guys are doing, what you're seeing in tokenization that has been helpful for flows, liquidity, settlements? What are new programs that you are excited about? What is working and what may not be working so well?
Okay, maybe I can set the stage first, right? I think for 2025, we see this as a very exciting year because it's really the convergence of three things, right? Three vectors. One is regulatory clarity. Secondly is in terms of institutional adoption. And three, technological maturity. And what this has done is that, why this is so significant is that because for the first time, we are seeing in 2025 a favorable regulatory stance coming out from the US, right? And this has in turn created a great environment for entrepreneurs as well as investors ourselves to be able to build, invest, and scale with confidence, right? And that was really, when we see two acts like the Genius Act as well as the Clarity Act, although that's still draft legislation, coming into form, right? That's really leading the regulatory clarity as well as what we call regulatory renaissance, right? And apart from the regulatory progress, we're also seeing, what industry observers are calling the stablecoin summer that's really happening in the industry right now. And the numbers that we're hearing is staggering, right? 275 billion of stablecoin circulating supply. And then when you look at B2B payments, right, it's about, the space has grown like 25-fold from about 125 million somewhere in January 2023 to, these are monthly payments, to 3 billion in February 2025. So 25-fold. Now, FIs might sneer at it and say, compared to what we are looking at and dealing with in trillions, this is really small, right? But it's the level of growth and the velocity of payments that we're seeing that's really exciting for us. So then, if I was to put all in all in together, I think that's really what excites us. And I think, my friends, Imu, Dan, you'll be able to speak more what you're seeing in the industry.
Yeah, maybe I'll go next. At ADDX, we have been offering tokenized financial investment products since 2020. But I think I echo what Laura just mentioned. 2025 has been a very exciting year for us. Not just because there is some news around the Genius Act or some company going IPO, but truly, the transaction volume we are seeing in the market on the platform is actually growing very fast. It's doubling every year. So we are seeing the adoption and also more people are receptive about the idea and what are the value of tokenization. So across the spectrum of different products, be it a private equity fund, hedge fund, it can be a fixed income, single bond product, it can be a structured product, it can be a pre-IPO secondaries. These products can be tokenized and also when you tokenize, we can make it we can also fractionalize it in a way that is more affordable to more investors. They don't have to bring in 100,000, 200,000 for the investment amount, but they can purchase this kind of investment starting from 10,000, 20,000. So,
do you mind honing in on one particular product that investors have benefited a lot from?
Sure. I think it's a good thing to note that actually, I think the good example will be our digital bond program that we have. This program was designed for small to medium-sized enterprises. So what it really does is actually by using this digital bond issuance program, the companies can lower the issuance costs, and actually they can also tap into debt capital market, which previously wasn't really available for the size of the company they are in. Also, from the investor point of view, it actually benefited them a lot in a way that now they can access different profile of the fixed income product that gives them a better return than their typical fixed deposit they put in. Tenure can be also structured 3 months, 6 months very flexibly. So because we are using blockchain and tokenization as our technology infrastructure, this can be actually quite efficiently managed, and the back-end operation can be also quite efficient. So I think this has been also very popular product that we have been selling since last year, this year, throughout this year as well.
Thank you.
Sure. So picking up on, I guess, digital cash side of things and digital money, I think to what Laura said is the stablecoin summer has been very real. The numbers speak for themselves in terms of volumes. I think focusing on what the label here is, liquidity settlement, it ticks all of those boxes where it relates to moving money cross-border. So I think a lot of those use cases, all the way from crypto native, where stablecoins have been used as the kind of crypto attached element, all the way through to remittances, B2B type use cases. There's been a significant volume increase and increase in interest in conversations as to how they get there to leverage stablecoins and or tokenized deposits, differentiation in how they're managed, all the way up the curve up to the bigger banks. And the more jurisdictions in which they're operating, the more value they can see from moving that money faster. And whether that's removing the likes of pre-funding or it's actually trying to mobilize assets more quickly, settlement itself will reduce risk just by nature of how quickly they move. And then they can do more with it, whether that's in a lending capacity or otherwise. Aside from digital money, and just one comment on the market size. It's been referenced a few times, and we talk often about the quantum of stablecoins in operation, market caps versus M1 money, for example, and it's in the region of 1 to 1.5%. That's still a reasonable quantum in where it's been, and if projections get close to where they're predicted to be, that's going to be pretty momentous. If in a 2030 basis, a lot of the numbers that talk about the 10 trillion, 12 trillions from the big banks' views, we've got a slightly more nuanced view, but more centers around 5 trillion in tokenized assets as a whole, around 1.7 of which would be digital money. And I think that's going to get outpaced pretty quickly at the rate of knots that stablecoins are being adopted into right now. And just this morning, I checked that number's more like 309 right now. So again, things are happening very quickly. I think the penny has dropped where it relates to banks and leveraging these things in Treasury. The ability to move liquidity faster cross-jurisdictionally is a pretty powerful thing when you're sitting on large sums of money and paying significant pre-funding. Likewise, certain currency corridors across emerging markets, notoriously long settlement cycles that can get quashed into a matter of minutes in some instances. Granted that the maturity curve that the entire of that value chain is on moves to a place at which you can use that infrastructure to on-ramp, to off-ramp, to mobilize all the things that are needed from a service perspective.
Actually, what I think is really interesting, it's also not just about the stablecoin innovation, it's also about how TradFi and financial institutions are also leaning in, particularly on two fronts, right? We've seen like JPMorgan announcing that JPMorgan tokenized deposits on public blockchains, right? And this was something that was unimaginable like a couple of years ago. And closer to home as well, 2 days ago, I believe we read the announcement that DBS as well as Kinexis was also exploring cross-border money movement on tokenized deposits. So that's really a huge point to see that TradFi is leaning in very strongly. Then of course for us as well, Temasek has Patio that does cross-border wholesale clearing and settlement as well. And we were seeing a lot of FIs from multiple jurisdictions asking us, right, how do we actually use new technology to better serve their customers? So actually, it's the demand that's coming from the end customers that's forcing the banks to also move ahead in times as well.
Very much so. And likewise from the corporate side.
Yeah, so just to put you on the spot, and before that, let me frame it for the audience. Oftentimes, we think about open chains versus closed chains. The banks run very closed chains as opposed to the public blockchains, which are open. On the other front, everyone else is working on stablecoins, which are on open chains where you can do anything you want with, and there are a lot of banks that are working on tokenized deposits. So that's kind of the grid on where most products could potentially land. Everyone has a different idea on what could be useful for certain circumstances, but that's kind of the grid to think about. And so before we move on to regulation, based on the pipeline that you see, and I know Fireblocks is the #1 infrastructure provider for wallet services, are you seeing more tokenized deposits or stablecoins coming on board in the next 12 months?
If I take the flow that we've seen in the last year as an indication, it'll be stablecoins because they've just moved faster. And that's because we got a more of a digital native client base. That's getting more and more institutional all the time. And I think we're going to see more of a balance between the two as the banks and FIs really lean into the ability to tokenize deposits that are already on their balance sheet. And again, the balance sheet treatments are very different between those, as are contemplating operating in open public blockchains for many of those truly institutional end of the spectrum. So I think there's going to be a journey for that, which pairs with the regulatory clarity and maturity, which endorses that more open ecosystem. And I think there's some roads to cross there first, notwithstanding the progress and the steps that are being taken between the likes of JPMorgan and DBS to start connecting more of these closed ecosystems to find more scale and value, because that's where the value will come.
Perfect. So Burkhard, I think Laura's mentioned regulation from the US. The MAS here in Singapore actually has been a real leader in a lot of regulation in crypto. We're talking about stable coins. We're talking about a lot of these other things. We know that Bundesbank, the ECB as well, has always been looking at these issues. We would love to hear where the view is, how that's changed as the rest of the world has been making these moves.
Well, thank you, Richmond, for your question. Of course, digital money can be offered in many forms, that's for sure. In the Euro system, that means the ECB and the national central banks of the Eurozone pursue to develop a payment and settlement system which enables new innovative instruments, and also, of course, and this is a task for central banks, to guarantee also in the future stability. So in a couple of years, we will see in Europe definitely all forms of digital money. We will see a CBDC on the retail side, the digital euro. We will see wholesale CBDC for the settlement of large value transactions. Then, of course, stable coins, which will be denominated in euros. At the moment, we have already some, I would say very few, but this will, of course, also come much more in the future in Europe. And then hopefully, and that's our topic for this afternoon, tokenized deposits, of course, then issued by commercial banks. And in addition to that, Richmond, we should not forget that also traditional rails will further develop, for example, by broadening the use of fast payment systems, including cross-border interlinkages. This is our big topic also in the central bank world, cross-border payments. When I look at the discussions in all the international bodies, CPMI, FSB, wherever, we are talking about what could we do, how could we achieve even more effective cross-border payments. So this is also for the central bank world, one of the top priorities. And all forms of money, digital money, will definitely have their justification. That's also my personal view, not only from a central bank's perspective. However, and you won't be surprised that I will say that here on stage, from my point of view, central bank money must remain the anchor at the best of all forms. So we are also, of course, pushing for that. At the end, the singleness of money is important. A euro must everywhere and at all times a euro. That's absolutely clear for us. Whether we have it in our wallets in cash, in many countries of the Eurozone, cash is still a valid topic, I can tell you, and it's important to the people, but also then in the future in a digital form. And there could be a problem if not properly regulated. Stablecoins will display deviations from the one-to-one relation. Of course, we see that very clearly even by now. The elasticity of money must not be jeopardized. Also in that respect, we are very clear. The transmission process of our monetary policy must not be disturbed. And at the end, the integrity of money, and this is also key for the people, the consumers, the users, the integrity of money is to be preserved. By integrity, I mean here three aspects. So money has to fulfill all functions of money. So I mean here transaction, value preservation, and then of course the computing unit. And then secondly, money has to be based on a proper legal basis and governance. And lastly, money must flow in safe, efficient, and also resilient infrastructures. To come to an end, the payment system should not be fragmented by new forms of money. Interoperability is key, and my institution, the Bundesbank, the German Central Bank, together with our partners in Europe, make sure that European legislation and regulation will achieve all of the just mentioned objectives.
Thank you very much. Just a very quick follow-up. I think that was very interesting. Now, you mentioned different types of money, starting with CBDCs and many different users, including store of value, payments, and cross-border, stuff like that. Where do you see CBDCs filling the largest gap in a few years from now?
Well, when I look at the wholesale side, there's clear demand from the market. Wherever I'm talking to, or whoever I'm talking to, it's clear banks, other payment service providers, other financial infrastructure institutions say it's good when you're speeding up here your efforts. And the Eurosystem will have, I would say, a full product in that in a year from now to, that means end of 2026. We are working hard on that. We have a specific project, it's called Bridges, and then this is for the wholesale unit. On the retail unit, it's more difficult, I have to admit. So I'm also very frank here, but at the end, on the way, and I said that many people are still very close in using cash, and we are living in more and more digitalized times. Well, this festival shows us that perfectly, I would say. Then, of course, we have to think about what this means for our core product. And so far, cash is still the core product of central banks. And so we have to think about what this means for a more digitalized world. And that's why we are going also for a retail version then of the euro, the future digital euro in a retail form.
Yes, thank you. I'm very excited to see that. I'll share a personal anecdote. My previous role was co-founder at Paxos. In 2015, 10 years ago, we started discussing a partnership for instantaneous cross-border settlements with Euroclear. And then we announced that in 2016. And unfortunately, it didn't go very far and was shut down in 2018. So hopefully we're seeing that was a decade ago, more than, and so very excited to see so much movement coming.
We are really determined to this project. So for us, it's really key that we will get the digital euro in different forms. I spoke about wholesale, but then also in the longer run, a retail version. And I can really tell you the entire euro system is committed to these projects.
Very excited. So now moving on, so there seems to be a lot of positive movements. Everyone's been talking about that. Products, seems to be quite focused on stable coins as well. What could go wrong? What is something bad that you guys foresee that will slow everything down quite drastically? If anyone wants to, Laura?
Yeah, sure. I think it will really depend on which stakeholder hat you are wearing, right? If you are the consumer, it would be based on, what was your user experience and what are the risks involved, right? And what's the consumer protection for end users. When it comes to institutions, then potentially it's about, regulatory clarity, as Burkhard has mentioned, right? Are there frameworks to ensure that, regulated FIs can, comply with the regulations and they do not trip up these regulations because they are licensed entities, right? And they need to also preserve, the confidence of trust that's enabled in them by both the stakeholders, the government, as well as the consumers, right? So that's that. And then when you think about it from the regulator standpoint, then for them, it's really how do you balance between innovation as well as the broader consumer protection, investor protection, right? So a lot of things are still being figured out right now, but given how far we have come from where we were, and you were just mentioning, about 10 years ago, some of these collaborations didn't pan out because we didn't see the conversions of what the Chinese always like to say, right? 天时地利人和. You need the gods to be blessing it. You need, the people. You need, the regulations as well as the environment. So the technological environment, technological maturation, like I mentioned earlier on, plus, regulations and institutional adoption all coming in together, then that breeds, fertile ground for, more innovation in very clearly defined parameters. And that in turn, will lead to, better education for the consumers, better confidence for the regulators, to also see where they can balance between innovation and not stifling it, but yet also maintaining protection for all stakeholders involved. So it's a complicated process, but it's somewhere where I'm confident that we can get towards.
No, I agree. I think a lot of those points you mentioned 10 years ago, we didn't really have. We didn't have scalable blockchains. We didn't have clear regulatory oversight of the space. And I think one thing that will become a big important topic is that we didn't have AI passing through so much information that was readily available but cannot be done by humans. So I think that hopefully it's different now. Right?
Actually, picking up on that point, and not to monopolize the conversation,
please.
But I think what's really interesting that you mentioned AI, because when I think about blockchain and I look at AI, AI has revolutionized labor, right, in enabling faster, cheaper, more efficient, more efficiency there. I see blockchain revolutionizing capital in a very similar fashion, providing more transparency. Secondly, reducing friction, as well as promoting more innovation in digital primitives, right? So to that extent, this is all enabled by, the velocity of financial payments, as well as improvements in where we see, digital primitives being able to enable new models, new use cases, because of the programmability. So we are living in very exciting times whereby I do believe that, you will see new innovations coming up, and very, very happy to be, part of this.
Yeah, no, I think that especially when we talk about blockchain and stable coins, people are always talking about speed. And I always say that, I'm a huge fan of stable coins, by the way, but I always say that the slowness in TradFi is not a bug, it's a feature. And stablecoins should be trying to solve for that in almost instantaneous speeds, rather than to just say, hey, we are faster. Anyone else wants to share?
Yeah, I'll jump in there with just layer on what Laura's already said. From a less from a what could go wrong, but more from what needs to be solved for, I guess, to be able to get the scale. So stablecoins, again, it's front and center for everyone. In terms of scaling that properly, there's got to be a way for institutions to be able to tap that liquidity globally. So adoption is uneven, supply is sometimes uneven. More minting banks, more so on, grow the networks. There's only two that really have the network effect, and that's got to grow. That's got to be available. So for institutions to truly buy into this and adopt at scale, there needs to be this, simply liquidity that removes the risk aspect of that. Second, the infrastructure layers, which is where we come in, as well as many others. But there's layers to that. So how can we make things truly secure, because that's a given, but interoperable at scale? And there's many ways that we can talk about interoperability. It's a bit buzzy, but the reality is you need to be able to move money cross-chain and assets cross-chain. It's not just money we're talking here. But we need to be able to do that without the friction, without the cost that people see today, to be able to solve the problems. We currently support about 120 different blockchains, and that's integrated and abstracted away from the end users. So when I talk about layers, I talk about abstracting away from some of the complexity and the heavy lifting that's required to be able to adopt into some of this stuff. Mm-hmm. So I think that's a big thing that is going to be the focus of many that are on the infrastructure side specifically, to be able to unlock that next wave. I mean, we could sit and spend the next hour running down on things that need to be solved for, but there's just a couple. I mean, liquidity is huge. It gets talked about a lot. In terms of regulation, I won't get too deep into that. But the reality is, moving money cross jurisdiction, cross border, there needs to be, again, looking through an institutional lens where the money kind of really ramps up. It's going to have that legal certainty. So, again, recognition from where we're talking collateral and its titles, it's all of that kind of language that people are familiar with today that needs to be transposed into that future state digital world to have an equivalence. And then people grow ultimately trust and faith in that system to be able to then adopt it. So it's a self-fulfilling kind of prophecy.
So on that, sorry.
I echo what Dan just mentioned. As a platform operator, actually stablecoin is also very important to us. It's actually part of our next year's plan as well. And especially the cross-border payment, when we are also looking at very aggressively next year, we are looking at global regional expansion. So actually, it's not, I don't think it's a big problem, but I think our main concern is actually the regulation side, where different jurisdictions, when they start to look at things slightly differently, it's actually very difficult for platform operator like us to be able to move fast as we want to be. There will be a time that we need to slow down. So that's actually one of our main question marks moving to next year. But I mean, generally, it's going to be quite exciting year next year, looking at what's happening in 2026, 2025.
Yeah, and the practical things, Immu, just to layer onto that as well. The realities, practical realities of doing business in these circles across the multi jurisdictions. You have to get the disciplines right around risk and compliance. If we're talking in any kind of regulated settings, these things are essential. Yeah.
So let's stick on this topic for a while, because this is one of the audience questions as well. Oftentimes in closed door settings where there's more than one regulator present and someone says, can we align regulatory approaches to stablecoins and payments? And it usually gets a good laughter. Why don't you tell us what you think are the key challenges to getting us internationally aligned?
When we are talking about stablecoins and those kind of systems, at the end, from a European perspective, we have already a regulation on that, MiCA. For me, it's a starting point, definitely, but we have set a regulation. Of course, you're absolutely right. This is an issue, global issue. At the end, of course, we have also to speak to other jurisdictions on that. But the global bodies are very much heading towards thinking how to regulate this. There are standard setters like CPMI, for example, where all the relevant economies, central banks are also involved and have members in the committee. And I can tell you, this is definitely one of the top priorities to think about how we can get this regulated on a global level. I know that's quite difficult because of all the geopolitical fragmentation we do face at the moment, but at least we should try to get here an appropriate regulation. That's my view on that.
Got it. Great.
I think it may be also useful to think about it, right? That when you look at history, usually for early technologies, right, they go through a fragmentation phase, right? Therefore, and then later it goes through a consolidation phase. And it's very important that we need to have diversity of thought. Because if everybody converges too quickly or too prematurely on a single approach, it might lead to unintended consequences. Now, of course, I do agree that the real risk, of fragmentation in terms of standards and can we have better global harmonization is important because it also creates friction for businesses who have to comply to different operating rules, and it creates complexity, operational complexity, and even inefficiencies for them. But all in all, I do think that we have seen a greater push, from regulators to come together as well to think of eventually whether there is a, for lack of a better word, a winning standard or whether the market can identify whether there's a winning standard whereby we can coalesce around, right? So until we find that, I think. Unfortunately, what it means is that we will need to go through this phase, but I'm very sure that we can come out of it stronger.
And Laura is absolutely right, because the long-run costs of segregated markets are high, definitely. The risks of suboptimal solutions are significant. And then the processes to undo fragmentation, to create a new harmonized governance are definitely cumbersome. So that's absolutely the point she mentioned.
Right. So it seems like we all agree that fragmentation is not good from a regulatory standpoint, from a product standpoint, and from, I guess, tokens and monetary standpoint. So I want to take this audience question, and maybe we can kind of relate these two topics. The question is, which model truly scales globally with finality? Deposit tokens or stablecoins, and what prevents systemic risks when they interoperate? So a couple of layers there, right? You're seeing two different types of risk, right? One is you're trusting the issuer versus trusting a bank, and how that gets backstopped. Very different products, really. Would anyone like to start?
Happy to take. Everyone's looking at me, so I'm going to take a step first. Yeah, I mean, there's a lot in that question, but just at face value, what prevents systematic risk or systemic risk? I think they're both going to have their own use cases. So if I just take one step back from that momentarily, they're going to have their own use cases. We have a view that they will be interoperable. There will be stages to that life cycle in which a deposit token gets used and or a stablecoin gets used. Cross-border at the moment, it makes all the sense where you're going externally for stablecoins. Again, if you need network, if you need reach, you need the partners. So as soon as you start open network, systemic risk, again, it's down to security. If it's deposit tokens, that's more of an internal-facing bank issued, more a closely governed, controlled environment. So I don't see that at a global scale being systemic kind of risk indicator or potential for. Stablecoins more so, but in terms of the interoperability, I'm not sure I understand the interrelationship there as why that would trigger greater systemic risk. I think it's more the participation in that global ecosystem, I would say, that would be the catalyst for such risk.
I think it's the way for them to be swapped out easily makes size hard to control, and also tracking a bit harder to control. It's my guess on that question. Does anyone else has anything to add?
I see that there could be a bifurcation, as Dan has mentioned, in terms of use cases, right, between high-value payments and low-value payments. When I think about high-value payments, I think I agree with Burkhard, right, when you say that, look, Will we depart from the M0, M1 type of construct? Personally, I don't think so. So that's where tokenized deposits come into play as the M1, no different from what we are seeing today, but in a digitized form. How does stablecoin interact with tokenized deposits? Well, I do see them as like, they have different issuers. That's the difference. And potentially they're quite akin to e-money, which is really existing in today's ecosystem in a sense. So not quite the same, but also not quite different. I guess as they scale up, and when we're talking about interoperability, right, do we really see the two instruments being able to interoperate with each other? Question mark, right? I don't know. Today has not happened yet, but what if the banks issue their own stablecoins? Would that be a game changer then, right? Then how different would a bank issued stablecoin be from a tokenized deposit, right? And if that stablecoin was to interact, let's say, with a USDC, USDT, how would that work, right? I think that's when Burkhard mentioned about central bank money needing to come in, right, to anchor that trust. So would the model we see today be the model we see in the future? Question mark.
Right. So I think we're out of time. And if you allow me to end with just on this topic, everyone thinks that banks are a lot more secure than stablecoins. I unfortunately had to oversee the unwind of a $24 billion stablecoin, one of the largest, a 24-hour bank run that lasted weeks, less, not a single delay. Everybody was paid in full, no risk whatsoever. Shortly after, Silicon Valley, signatures, and the list goes on. So I do think that a well-ran stable coin with proper backing and everything else, and none of us were regulated back then, it can be every much as safe as a tokenized deposit.